Hi and welcome to Erik Penser Bank. My name is Jonas Thulin. I'm head of asset management, and I will briefly, like a tip of an iceberg, show what we're thinking about the markets right now. Because this is a very exciting week, or there has actually been a quite interesting couple of weeks behind us, that we've seen a new paradigm opening up, which is a reason why we have stuck with our overweight equity positions. We haven't been too penalized for keeping those because we have a great returns from our commodities and alternative investment side of the portfolios, and our hedge has been doing tremendously well. So despite being almost maximum overweight equities, if we had sort of neutralized that position, we actually wouldn't have made more money. And I think that's a key for us, because then the hedges are working and we can easily drop those if we write on this new paradigm. In terms of global benchmark and global equities, yes, we're still outperforming. We're getting close to the 40% threshold that we've been bouncing around a couple of times in terms of difference between us and the dollar index. We don't have to go through this, but most of our strategies are actually now starting to outperform the global benchmark. And those are underneath it. The big blue here is the global benchmark, are all growth strategies. And those are the ones that we've been holding on to. The reason why we've been holding on to them is that we've seen this paradigm shift opening up that we are so desperate to capture. And this is really the core slide for this week, where we can depict and derive the different paradigms. We usually do about 2 or 3 paradigms per year. Once you find the trend or you find the theme the market is trading upon, you can easily plug into it and enjoy the ride, basically. Or you chase around until you find it. This year we have shifted, so now on our 6th. To the upper left you can see political risk. This is R2, R square in terms of statistics, so both direction and magnitude in terms of the relationship between US political risk and the equity market, which was non-existing, and then all of a sudden Trump became the most popular presidential candidate in the US, and the market started trading on US political risk like crazy. That completely disappeared as we entered the geopolitical risk area, and that completely then transformed. So it completely slided out from top of the agenda for the market in March, and we rolled into short-term inflation outlooks that we traded. That completely disappeared again, almost as quickly as geopolitical risk. Now, of course, we're not saying anything about the humanitarian catastrophe and the massive and the awful war started by Putin here, but for us it's more interesting to see where the market is focusing. And the shift went into the profit outlook. Here you could argue that we made a mistake, or you can argue that we made the right call. When we saw that the market was starting to trading on the profit outlook, and we saw a really interesting setup in the market, we increased and we took off some hedges. Now, as the market lost traction on profits, and we still couldn't see that growth was picking up the slack in terms of being in the attention area, we actually slapped on the hedges again. That time around we did it a lot less expensive, but it was of course a disappointment, because then what took over was the financial conditions that completely ran the markets for a little while. And as you can see, all of a sudden, around the 12th of May, the second derivative of the R square starts to roll over and then turn negative. And what came in there in like a knight in shining armor was US macro. From that date, around the 12th of May, we can see a tremendous shootout in US macro. Today, all we need to explain and derive why the equity market is closing up or down, we just need to look at daily updated US GDP estimates, now costing data, and so forth, a lot of high frequency data that we can quantify. You have 4 of our main series of those. I've actually hidden what they are on purpose, but it's quite easy now to follow US developments per day. And as soon as you have that data, you know where the equity market would turn. And that explains 90% of the equity market. So we leave 10% on the table for something else to derive. In terms of the Swedish equity market, this explains 80% of it. So this is a core for the entire market. Now, given our view on US macro, we are still very positive and constructive, which is why we have hung on to our overweight positions throughout May, because we can start to see this already, what was that, the second week of May. And now finally we're starting to get some rewards in the equity market. It's been a couple of weeks of waiting, and we're trying to be relaxed in the meantime. Big theme that's behind all this is of course the CPI outlook, and we've been arguing since March that was the peak in priced inflation. We stick into that call. You can see here on break-evens rolling down. We don't see a pressure in China. We know there are a lot of graphs or pictures on naval vessels in China going around. At the end of the day, we need to find the data, what it actually means, and it's been rolling over. Supply bottlenecks are getting easier and easier. If you look on the US, we actually have the easiest supply bottlenecks now since early 2021. So things are happening here quite rapidly. That has a tremendous effect on inflation expectations. So if you look on the left-hand side, this is a one-year outlook for inflation expectations in the US. We have fallen from 8.5% to roughly 3.75%. So we're shaving off almost 5 percentage points of the expected inflation. That's a huge move that the equity market has not reflected. The fixed income market, inflation swaptions, yes, they are starting to roll into this. Commodities, yes, they're also starting to roll into this. The last kid on the block that should realize this is, of course, as per normal, equities, which is why we're keeping our constructive, positive view on the equity market, that we will come around to realize this. And the first couple of weeks or days, magnitude on upside momentum are always the most volatile. We will not be able to capture those unless we have the positions on ahead of the game. And this is why we hung on to the equities in May. Now, this could all turn out to be wrong, but this is our strategy for the time being. One thing that we are looking at is, of course, the next paradigm. And one thing that we are keeping an eye on, I really encourage you to read on this slide, is the stress that the quantitative tightening will have in the US. Now, we can read that stress from various different angles. One of the easiest ways to do is, I think, is go into the plumbing on the US fixed income market and look at spreads between different rate curves and rate points. Basically, here you're looking at the Federal Reserve interest on reserve balances versus the federal funds effective rate. And if the federal funds effective rate becomes higher, i.e. you have to go there in order to find liquidity, you have an issue like we had in 2019. If we try to weed out who is having the issue, we can actually do that by looking at the fixed income and see how many people are, what is the rate in different percentiles. This is the 99th percentile, i.e. someone had to go to the market in 2019 and borrow overnight liquidity at 9%. This is not a favorable indicator for the equity market if that was to happen again. It's impossible to know when and how and at what level. So this is something that we look at now daily on a tick-by-tick data in order to try to capture. But this is a paradigm that we think will come back during the autumn, together with the US election, which more or less seems to be an open and shut case in terms of Republicans taking over the Congress. And also note that the runner-up to Trump in terms of presidential election 2024 is DeSantis. So there seems to be a strong movement right now behind the Republicans. Now, before I go into macro, there's one thing that I just have to bring to your attention. If you are afraid of interest rates moves in the US, which you can see how it starts to depict or cause stress on the top line in the US, the first thing you should actually do is to sell off Europe. This is the sensitivity to US interest rate changes in terms of beta from 2001, 2009, 2022. And you have the beta, which is very high and positive in Europe, not so much in the US. This is one of the reasons why we got rid of European equities. If we start to see rate stress in the US or financial condition stress in the US, sell Europe. It seems perhaps a bit counterintuitive, but due to the nature of the game and our economies, etc., this is just the history, and we just follow the data. But I think it's pretty interesting to this whole discussion of US rates here and there. If you are concerned, by all means, buy Latin America, buy emerging markets, and sell Europe. So why are we then optimistic and positive on the equity market? Well, first of all, in terms of our broader risk indices, if you look at CDS's rate spreads, FX vol, fixed income vol, emerging market rate spreads, we're not taking out new lows since we had the biggest signal in early 2022. This is a positive sign. If we roll on, which is actually just the second week in 2022 where we're in positive fear and greed, which is a huge development, I think. Because finally we're getting the signs aligned for something more positive to happen in the market. If it will materialize or not, it remains to be seen. We like to follow data, and hopefully we get it right that we got to see a little bit of, at least a bigger bump in the equity market. Now in terms of JP Morgan's quant model built on vol curves, yes, we had the buy signal building up and it sort of dropped off, i.e. the buy signal holds. We've been handling this sell-off by trying to spread away beta from alpha, because we can't allocate more to equities as it is. So that's why our next question will be to drop the hedges basically. Now, if you look at Bloomberg, they're great in printing out, what are people looking at in terms of time the market. And on the top left-hand side, you have some of the usual caveats: high versus low, advance versus decline, bullish, bearish, vol curve. As you can see, if we try to put a momentum on these things, we have a hugely positive signal. It's actually the most positive we've had now since the 2020, 2016, 2015 sell-offs. This is the reason why we stay overweight. Yes, we jumped on ship in early March as we saw the profit outlook, or the profit start to run the equity market. We got that run fairly good throughout March, and then we had to pay it all back. But we stuck with equities, increased hedges, and the reason why we stuck with hedges is because the next paradigm is just around the door in terms of growth, and we are optimistic on US growth. We do not see a recession. And I will I can also throw in that we're not alone in this, because finally we're getting some people on our sides in terms of increase in equity allocations. In terms of growth, we can start by looking at earnings revisions that we still will come back up down to economic surprises, which are still positive in the US. Of course, hugely negative in Europe, but then again, we only have a healthcare in Europe, which is beating the world index, so that's fine. But we don't keep anything else in the Eurozone. But earnings revisions should start to turn around. But then again, do remember that earnings revisions is a severely lagging indicator, so we can't actually take any positions in the future on top of it. Now, it all boils down to growth then, because you can already see that growth is explaining about 90% of the US equity moves in terms of direction and magnitude. If you look at about 3,500 different data points in the US, you can actually see that US GDP growth is looking quite robust. It's even accelerating. If you look at my own high-frequency model, which I built on 217 data sets, you can actually see a pickup again in the second quarter. Not surprising, given how awfully bad the Q1 was due to trading and inventory assumptions, not actual data, but the assumed inventory and trade data. Obviously, there's going to be a rebound. But the positive thing is here that you have a positive momentum in the data series, which is quite in stark contrast to what we see in Europe and in Sweden, for example. The recession probability in the US is about 15%. If you look at the macro, which I have depicted here, if you look at New York Fed's recession probability indicator, is around the same vicinity. It's actually a bit lower, around 10%. If you look at the recession indicator based on credit spreads, it's 14.5%. It's very hard to find anything substantial with a likelihood over 20%. Now, we can put that in contrast, if you allow me to flick a few pages, to the ISM and S&P 500, which is pretty much priced in an ISM level of sub 50. That means ISM either has to collapse very, very quickly, or the equity market has priced in recession. That's not going to happen, at least not going to happen in the next quarter or two. For us, that's enough for getting a solid rebound in the portfolios. For us, this kind of probabilities, 75% price in the equity market, maybe 15% in macro, that's a risk reward that we can live with and we actually want to exploit and then take a bet on. Is there any risk then the ISM will collapse? Well, we tried to then forecast ISM, which is our last graph for this week. And there are numerous ways of forecasting ISM. We like to build up from survey data, which you have on the far right. We build it up on traffic data, i.e. how much is driven on the highways, railroads, waterways, airways. You can actually see it pick up as well. Or we can look at the market in terms of credit spreads, commodities, political economics, and uncertainty. You can actually see the pick up as well. So we think the market has been way too pessimistic in pricing in this recession, which is priced in as a fact to 75% probability. We think that's a good risk reward to go against this, at least in the short term, and we want to exploit that by keeping growth strategies in our portfolios hedged in order to be able to sort of live with them in that sense, and also working actively on the alternative side of commodity in order to counterweigh the sell-offs that we see in the equity market. And then once we get the rebound that we start to see started developing on the 12th of May, trying to capture those by pretty much dropping off the hedges. We haven't done so yet, but we are certainly looking at it, and right now just enjoying the fact that the growth side of our portfolios are growing so good that we still keep beating the world index on the upside without even dropping the hedges, which is almost a spoiled situation, and it's something we had to revalue every single day, of course. But that's our point of view in the market. Of course, this is all helped by the fact that ISM has dropped off. The war premia on priced inflation in the US has dropped off by 58%. Price inflation in terms of expectations has dropped almost 5 percentage points. So there's a huge move in the inflation market in the US. And as I said before, I wouldn't be surprised in the summer if someone starts to talk about, well, maybe it wasn't that non-transitory anyway, depending on the definition of transitory, of course. But I'll leave you with that, a bit more constructive, a bit more positive than been before, and I think we're getting good traction in the market, and we have so for the last couple of weeks. And also the underlying in terms of highs, lows, advanced declines, everything starts to develop quite neatly for a constructive view. And also do remember we have positive gamma in the options markets, which of course helps the equity market as well. So with those a bit more optimistic, constructive words, I will leave you with that, and I will be back in 2 weeks' time, because next week we will be celebrating the Swedish, well, we don't have an Independence Day, I think we have an official flag day or something as exciting as that. But I will be back in a couple of weeks' time, so thank you so much for your attention.